Hello and welcome to your weekly technical update, your guide to the charts that matter this week. I'm Andrew Gagan. Well, in this episode, we look at the worst performing stocks on the ASX over the past financial year. Among them, Reese. The plumbing supply firm recently came out with a profit downgrade. Michael Gable from Fairmont Equities takes a look at its technicals.
That's why it's the fifth worst performer in the top 200. Look, up a few months ago, it was starting to look like it might be turning around. So, like most of the market, it bounced strongly in early April, and I've circled that towards the bottom right there on the chart. So really strong reversal there on Reese. Started to head higher for a bit after that. But then, that big drop last week when they came out with quite poor guidance. You could see that big red bar on the far right hand side. That sort of just destroyed any sort of potential positivity in that chart. So look, it's just back to looking a bit ordinary, unfortunately. Unless it can bounce strongly from here, and I can't see the catalyst for it to do so, you'd assume that it's just going to continue with that downtrend. So I think it's too early to be looking at this one as a buy. I'd have it as a sell, and I'd be looking for better opportunities.
Meanwhile, Domino's share price is well off its post-COVID highs. More recently, it's suffered with news that its chief executive has stepped down after just a year in the job. Here's what Michael Gable sees on the chart, along with Jonathan Tagadina from MPC Markets.
Stock is bad when you look at a big move like that on a long-term chart and you almost still can't see it because it's fallen that much that a 20-something% move is just a little dot at the bottom. And I reckon that's what the weekly chart would look like if you pulled up the latest. But yeah, this is a weekly chart going back, 6 years. We've spoken about this one on the show a number of times. Sort of that big run up was clearly a bit of a bubble there. Domino's, people trying to equate Domino's to being a technology company and justifying why it was on a high multiple. But when they go up, vertically like that, they usually come back down the same way, and that's what's happened. So it's been downtrending for years, and because of that, it's been an avoid for people like Jonathan and myself.
Once there's an actual news announcement where the market does opposite to that, that's usually a first sign of where the sentiment has changed. So you need sentiment to change on a stock like this for it to actually find the bottom. What I tend to do is I wait for something like that, a catalyst, and then also some price action, some follow through as well. So what that means that I don't want to be first out of the gate trying to pick that bottom. I'd let someone else go first, and then once I see some positivity, that's when I'd like to buy it. I've had Domino's on the call many a time. I don't remember exactly what I'd say each time, but just in general, I would say, it keeps heading down, so don't buy it yet. And as Michael said, it's a lesson that just because it's at $20, $40, $60 doesn't mean that it can't get any cheaper. The thing with the point that Michael's making is that with tech companies like Domino's, there could be so much hype that's built into it. You look at some of the most expensive companies in the world, like a Palantir, like they're at 500 PEs and just amazing numbers like that. And when they get out of favor, the contraction can just be amazing. So. Yes, I know there will be a value time for Domino's, but I don't want to be first. I don't want to pick that bottom, so it's still a sell for me.
Finally, a look at the worst performing stock on the ASX 200 in FY25, Mineral Resources. Here's the analysis of Jonathan Tagadina.
I would definitely stay away from minerals. And it's just, you're in a commodity that's been in free fall, and then you've got all these problems in the background. So you've got to see two things turn around now, rather than just the commodity price itself. So I'd rather just wait, because who knows what else can, what other sort of corporate, skeletons could pop out. That they've shown that. But yeah, I remember this thing was trading like the 160s, and where's it now? Just been a massive free fall and all that drama behind it. So yeah, eventually there will be some positive price action that tells me, okay, look, the worst is over. Again, I'd want to check out the short interest there. I didn't have time to actually check that out before the show. But if that short interest were to start dropping, that's when I think the bottom is in, or what to look out for. But yeah, for now, it's an avoid. And if I had to choose, I'd rather be in Pilbara or even, say, a Liontown. That would be my pick in that space.
Great.
And that's it for this week's edition of The Charts to Watch. Join us for more technical talk next week. Happy trading.